Hello, everybody. So, today we're going to talk about what I think is one of the most misunderstood areas of personal finance, and that is how income tax brackets actually work. A lot of people think they know how they work, but their understanding of them is completely wrong, and it leads people to think that they pay way more taxes than they actually do pay. And this is a misconception teachers in school I've had thought this was how it worked. Lots of movies and TV shows and just people you meet in regular life. I think people even will make raise or career decisions based on this misconception. So let's just talk about it a bit. So there's a concept called the income tax bracket. So the income tax bracket is generally understood as if you make between X amount of dollars and X amount of dollars, your income is taxed at a specific rate. So how people think it is if you make between $9,000 and $37,000, you pay 15% of your income, roughly. I mean, there's payroll taxes, there's deductions, but we'll just say in theory you pay 50%. How people tend to think of it is if you make $37,001, then your entire income becomes taxed by 25%. That is, your overall tax rate is based on your highest income. If that makes sense. So if you were making, in this case, $36,900 and then you went to $36,901, you would lose an additional 5% of your income with virtually no gain. And you'll see this joke in Dilbert and stuff where someone will get a $10 raise and they'll be like, oh, this puts me into another income bracket. I'm in trouble now. I'm screwed now, that kind of thing. And while there is a threshold for some government programs, that's a hard cap. So maybe a program is limited by $100,000 and you get a raise from 99,500 to 100,000 and $1,200 or something like that. Sorry, $100,200. Then you'll not qualify for the program. But that's not how income taxes actually work. How they work is different parts of your income are taxed at a different tax rate. So let's just look at this for a second. So the first income tax bracket is income on less than 10%. I'm not sure what this is based on. It doesn't really matter. Income taxes can be any amount. It's irrelevant. So let's say it's $9,000. So income between $0 and $9,000 is taxed at a 10%. So that means once you reach $9,000, you're paying approximately $900 in income tax. Okay, makes sense. So then the income between $9,000 and $37,000 is taxed at a 15%. So let's see, that's 27,000, which is the difference times 0.15. And that gives you $4,050. It's not as if they take the entirety of your income, which would be 37,000 times 0.15. No, that's substantially more than the income tax you would be paying. And so as your income increases, the different portions of your income are taxed different amounts. So when you hear talk about something like effective tax rate is if you take what percentage of your total income you're paying in taxes. So it's kind of, so you take all the money you're paying in taxes and divide it by your total income, and that should give you your effective tax rate. So in this case, the person makes a bit over $37,000. So their total taxes are equivalent to 16.7% because it's in between there and there. And then you also have the expression marginal tax rate. Marginal tax rate means how much would be taken in tax on the next dollar you earn, and that's just based on what your current tax rate is. So let's say you make $90,000 a year, we're just rounding. $187,000 a year. the next dollar you earn would be taxed at 28%. Whereas like your marginal tax rate at less than 9,000 is 10%. So that's something people use when they go, do I really feel like trying to make more money if 40% of it is going to get clawed back at higher income brackets? And then on top of that, you have a bunch of other things. Like you have tax credits versus tax deductions. From my understanding, a tax credit is you get X amount of money off of your taxes, whereas a tax deduction reduces your effective income. So, like in Canada, the RRSP, and I'm not sure if 401ks work like this, reduces your income. So if I make $50,000 a year and I put $5,000 of that into an RRSP, my legal income becomes $45,000, and the government will give me back whatever taxes I paid on that additional money. It also, I believe, changes your income for the purposes of qualifying for certain government programs and that sort of thing. Because for that reason, deductions are generally considered to be better. And some of them you can carry forward and that kind of thing. But hopefully, like in my incoherent financial rambling, you kind of get what I'm trying to get at here. It's not as if you make like $10 above the limit, all your income's suddenly going to be taxed. You're going to be making more income if you're making more income, so long as the next tax bracket is lower than 100%. Whether or not the tax bracket is too high to discourage you from really working is another question entirely. But I hope you found that interesting, and more videos to come, guys.